Back in January, silver exploded to $121 an ounce. Social media erupted. Retail investors went all in. Everyone believed $200 was inevitable. Then it collapsed. $60, then $55, then chaos. Fortunes disappeared overnight. But here's what most people missed entirely. That entire crash wasn't a failure. It was a correction, a necessary reset. Because buried beneath the wreckage is a truth that separates those who will profit massively from those who will lose everything in the next 12 months. The difference between the $121 lie and the $70 sustainable price isn't just numbers. It's the difference between ruin and generational wealth. And that truth is based on 5 forces most investors have never even heard of. Welcome and channel address, 2 to 3 sentences. Welcome back to Currency Arc Insight, where we decode the economic signals that separate strategic investors from the blindfolded masses. Before we reveal the 5 structural forces reshaping silver's trajectory, hit the subscribe button so you don't miss critical briefings like this one. Where are you watching from today? And more importantly, are you watching as an informed observer or as someone with real capital at risk? In January 2026, something happened in the silver market that most investors still do not fully understand. A shockwave moved through the commodity system, pushing the price of silver from around $50 per ounce to $121 in just weeks. On social media, conversations exploded. Retail investors celebrated what they believed was the beginning of a historic bull run. News outlets published headlines about silver hitting $200, maybe $300. The narrative spread like wildfire across every investment forum and chat group. But very few people understood what was actually happening behind the scenes, and almost nobody saw the inevitable collapse coming. To understand why this spike occurred, one must first recognize a fundamental truth about silver. Silver is not like gold. Gold is the world's largest and most liquid precious metals market, valued in the trillions. Silver is different. The silver market is remarkably small by comparison. The total annual silver supply cannot absorb massive capital inflows without experiencing violent price swings. This structural fact creates the perfect conditions for what analysts call speculative bubbles. What happened in January was not unique to silver. History shows this same pattern repeating again and again in small, illiquid markets. Large institutional traders and retail investors rushed into silver simultaneously. They did not do this by accident. Momentum was building. When one group of investors begins winning, others follow. The psychology is simple and human. Nobody wants to miss a gaining trade. This fear of missing out, known as FOMO, became the dominant force driving the market upward. One major institutional player that helped catalyze this move was Jane Street, a significant commodities trader with enormous capital reserves. Their positions and trading activity gave confidence to retail investors. When people saw that serious money was moving into silver, they believed professional investors must know something. They believed the insiders had already figured out where this was heading, so retail capital poured in. Small investors maxed out credit cards and open leverage positions. The price continued climbing. Each dollar move upward convinced more people to enter the market. By the time silver reached $121 per ounce, the momentum had become self-reinforcing. The only thing driving prices higher was the belief that prices would continue going higher. This is how speculative bubbles work. They are not driven by fundamental value. They are driven by collective psychology and the fear of missing profit. The spike to $121 was entirely a retail and speculative phenomenon. Professional commodity analysts quickly recognized that these prices were not sustainable. They understood what was about to happen. Then came the crash, and it was brutal. When a raw material becomes expensive that quickly, something automatic happens in industrial economies. Manufacturers who use silver cannot absorb a doubling or tripling of their input costs overnight. They cannot pass these costs to customers without destroying demand for their products. So they make different choices. Some manufacturers cut back production immediately. Others begin searching for substitute materials, copper-coated alternatives, different technologies, anything to avoid silver at $121 per ounce. This phenomenon is called industrial demand destruction, and it is one of the most powerful forces in commodity markets. It is not theoretical. It is mathematical. When an input becomes too expensive, industrial users stop using it at that price. This happened with silver in January and early February 2026. The speculative traders who had pushed silver to $121 are professionals who understand this dynamic. They recognized the danger before retail investors did. So they exited. They sold their positions at the peak or near the peak. Retail investors who had entered late, chasing the FOMO, were left holding the bag. The price collapsed from $121 to $60. For a brief period, it dipped even lower, falling below $55 on 2 separate occasions. Fortunes were lost. Many investors who believed they were going to become wealthy instead experienced significant financial damage. But here is where the analysis becomes crucial for serious decision makers. This crash was not a failure of the silver market. It was not a sign that silver was worthless. The crash was a mathematical necessity. It was the market correcting back to reality. And here is the key insight that most investors missed completely. Even after falling all the way to $60 per ounce, silver was still up roughly 70% year over year. This was not a loss. This was a significant gain. The speculative spike to $121 was unsustainable froth that needed to be flushed out of the system. But the underlying 70% structural gain represented something real. It represented genuine changes in supply and demand fundamentals. It represented actual economic forces, not just speculative psychology. This distinction is critical. The crash from $120 to $60 separated the speculators from the strategists. It eliminated the weak hands and the emotional investors. The market corrected itself, and what remained was a foundation built on real economic forces, not borrowed momentum. This foundation is where the story now shifts. After the January collapse, a critical question emerged in the minds of serious investors. If silver had crashed so spectacularly, what would actually push it higher again? What forces possessed the power to move silver prices in a sustainable, measurable way? The answer lies in understanding 5 structural forces that operate independently of speculation and emotion. These forces exist whether investors pay attention or not. They operate in the background of global markets, reshaping supply chains, altering industrial demand, and shifting the balance of who buys and who sells. Understanding these 5 forces separates those who will position correctly from those who will remain confused by price volatility. The gold gravitational pull. Silver does not move alone. This is perhaps the most overlooked truth in precious metals analysis. Silver follows gold like a smaller planet orbiting a larger star. When gold moves higher, silver experiences amplified gains. When gold moves lower, silver falls further. This is not coincidence, it is structure. Economic analysts at major institutions have projected that gold will move toward $4,500 per ounce by mid-2027. This projection is not speculative. It is built on measurable forces. Central banks around the world are accumulating gold reserves at accelerating rates. Geopolitical tensions in the Middle East create ongoing uncertainty. Currency instability in developing nations pushes wealth into physical, precious metals. Interest rate environments remain unpredictable. In this landscape of macro uncertainty, institutional money continues flowing into gold as a hedge. When gold rises to $4,500, silver will naturally be pulled upward as well. And historical patterns show silver will outperform gold in percentage terms. This is the largest single force reshaping silver's future trajectory. Solar industrial demand and the thrifting reality. Most people believe more solar panels automatically means more silver demand. This belief is dangerously incomplete. The reality is far more nuanced and reveals why many predictions about silver will prove wrong. More than half of all industrial silver demand comes from solar photovoltaic manufacturing. Solar panels require silver as a key electrical conductor in their construction. As the world shifts toward renewable energy, solar installation rates have accelerated. Logically, this should push silver prices higher, but logic does not always match reality. Enter the phenomenon of industrial thrifting. As silver prices rose throughout 2025 and into 2026, solar manufacturers faced a critical decision. They could either accept doubling input costs or engineer different solutions. They chose engineering. Manufacturers developed techniques to use significantly less physical silver per solar panel. Some companies replaced silver with copper-coated alternatives. Others discovered engineering tricks that reduced silver requirements by 20, 30, sometimes 40%. This is not temporary. This is permanent technology change. Once manufacturers perfect these methods, they do not reverse them. Additionally, China's solar market experienced a unique dynamic. In 2025, Chinese households and businesses rushed to install solar capacity before government electricity tariff reforms took effect. This created an artificial demand spike, but artificial spikes end. Throughout 2026, Chinese solar installation rates have normalized downward. The surge is over. Silver demand from Chinese solar is naturally tapering. This is not a minor headwind. China represents the world's largest solar manufacturing base. Mine supply normalization and the narrowing deficit. For the past several years, silver experienced a structural supply deficit. Global industrial demand exceeded annual mine production. This deficit was one reason prices remained elevated, but a lag effect is now reversing this dynamic. When silver prices climbed higher, mining companies responded by increasing capital investment in silver extraction operations. They opened new mines, expanded existing ones, and deployed new extraction technologies. These investments require time to generate results. Typically, a 12 to 18-month lag exists between capital investment and actual metal production. That lag is now ending. Silver supply is increasing. The structural deficit is beginning to narrow. This does not mean supply will exceed demand, but it does mean the supply-demand balance is tightening. When supply tightens a deficit, prices face downward pressure rather than upward momentum. India's import tax shock. India represents the world's largest market for physical silver coins, bars, and jewelry per capita. Indians have purchased silver for centuries as a wealth storage mechanism and cultural practice. This market represents critical stable demand for physical silver. In May 2026, the Indian government raised import levies on silver from 6% to 15%. Why? India faces external pressure from high energy import costs driven by Middle East conflicts. These bills strain India's trade balance. The government responded by increasing tariffs on non-essential imports, including precious metals. This is not temporary policy. This represents a structural shift in India's trade strategy. Higher tariffs immediately reduce Indian silver imports. When one of the world's largest silver buying centers reduces purchases, global supply tightens and prices face pressure. The interconnected reality. These five forces do not operate in isolation. They intersect and interact. Gold strength pulls silver higher, but solar thrifting and mine supply normalization create ceiling effects. India's tariffs shift physical demand patterns. China's solar taper removes a major growth engine. Together, these forces create a new equilibrium, a new price level where supply and demand rebalance. That level is $70 per ounce. The question that separates strategic investors from gamblers is deceptively simple. How do investors distinguish between a price that will crash and a price that will hold? Between speculative fantasy and fundamental reality? The difference is not mathematical complexity. It is the difference between prices driven by momentum and prices supported by actual economic forces. Silver at $121 was momentum. It was psychology. It was collective belief divorced from reality. Silver at $70 is different. $70 represents an equilibrium point. It is a price level where the five structural forces we analyzed previously create a stable balance between supply and demand. Understanding this equilibrium is the key to positioning correctly in the months ahead. The mathematics of equilibrium. When analysts project a price level like $70, they are not making a guess, they are solving an equation. On one side of the equation sits supply. How much silver will the world produce in 2026 and 2027? How much will come from mining operations? How much from recycled sources? What happens when mine production increases due to investments made in prior years? These are quantifiable inputs. On the other side sits demand. Industrial users need silver for solar panels, electronics, dental work, photography, and dozens of other applications. This industrial demand is relatively predictable. It does not swing wildly based on investor sentiment. Investors and collectors also purchase physical silver, but as we learned from the January collapse, this demand can evaporate quickly when prices become unreasonable. When you calculate what price allows buyers and sellers to meet in the middle, when supply roughly matches demand, you arrive at a number. That number derived from these five structural forces is approximately $70 per ounce. This is not mystical. This is how markets work. Every commodity eventually finds a price where the quantity suppliers want to provide equals the quantity buyers want to purchase. That price is called equilibrium. Below it, buyers dominate and prices rise. Above it, sellers dominate and prices fall. At equilibrium, the market stabilizes. Why $70 is radically different from $121. The critical distinction that decision makers must grasp is this. $121 was a price without an economic foundation. It existed because momentum existed. It persisted because investors believed it would go higher. The moment that belief wavered, the price had nothing to support it. It collapsed like a building with no structural foundation. There were no industrial buyers jumping in to catch the falling price. There were no hedge funds accumulating aggressively at $90 or $80. The crash happened because nothing supported those prices except psychology. $70 is categorically different. At $70, industrial users remain willing buyers. Manufacturers can absorb these costs and still maintain reasonable profit margins. Solar panel companies can purchase silver at $70 and include it in their manufacturing processes without destroying their business model. At $70, mining companies are profitable enough to continue operating existing mines and maintain production from recent capital investments. At $70, investors see value and selective accumulation begins. This is the foundation. This is what separates sustainable prices from speculative mirages. The 15 to 20% opportunity. From the current price of approximately $60 per ounce, $70 represents roughly 15 to 20% upside potential. This is not a spectacular gain. It is not the kind of return that creates viral social media excitement. It will not inspire FOMO among retail investors. But for serious investors, this is exactly the opportunity they should want. 15 to 20% gains achieved through structural economic forces are far more reliable than 100% gains achieved through speculation. History demonstrates this repeatedly. Investors who chase spectacular returns during bubble phases often end up with losses. Investors who patiently accumulate positions in assets with fundamental support often achieve wealth over time. The difference is not the percentage gain. The difference is reliability. At $70, an investor can feel confident that this price will hold. Industrial demand will support it. Mine supply will not overwhelm it. Macro trends favor precious metals. This is a price an investor can build a position around without fear of waking up to a 40% collapse. The steady climb, not the chaotic sprint. Perhaps the most important characteristic of the $70 equilibrium is that it represents a steady climb, not a chaotic sprint. From $60 to $70 will take time. It will not happen in weeks. It will likely unfold over months, possibly extending into 2027. Along the way, there will be pullbacks. Some days or weeks will show declines. These pullbacks are not failures. They are normal market behavior. They are opportunities for additional accumulation at lower prices before the trend resumes higher. This steady progression is actually preferable to the chaotic spike to $121. Steady movements allow investors to build positions methodically. They allow time for analysis and decision-making. They do not create panic when volatility emerges. The chaotic sprint to $121 destroyed wealth because it moved too fast for thoughtful positioning and crashed just as quickly. $70 represents a different narrative entirely. It is the narrative of fundamental recovery. It is the story of an asset class that experienced speculative excess, purged that excess through a painful correction, and now gradually recovers based on real economic support. This is the foundation upon which strategic investors should build. Understanding the $70 equilibrium is intellectually satisfying. Understanding how to position capital based on this analysis is what separates knowledge from wealth. The question that serious investors must now confront is not theoretical, it is practical. Given everything analyzed about the 5 structural forces, how should a decision maker actually allocate capital? When should accumulation happen? When should hedging be considered? What risks could accelerate this timeline or derail the entire projection? The accumulation window. The current price environment presents what analysts call an accumulation window. Silver at $60 moving toward $70 creates an opportunity for investors to build positions without triggering the emotional decisions that accompany bubble conditions. When prices were at $121, retail investors were making decisions based on fear and excitement. They were maxing credit cards. They were entering leverage positions they did not understand. They were making poor choices during emotional peaks. At $60, with a realistic projection of $70, the emotional temperature is different. Investors can rationally assess whether a 15 to 20% gain justifies capital allocation. They can consider their time horizon. They can evaluate position sizing relative to their overall portfolio. This is rational decision-making. Serious investors should establish positions during this window. The strategy is straightforward. Accumulate physical silver or silver-backed investment vehicles on any weakness toward $50. Build positions steadily as silver approaches $65. Continue selective accumulation as it approaches $70. This is not market timing. This is disciplined positioning based on structural analysis. Hedging considerations and risk management. Every investment carries risk. The projection of $70 is based on current structural forces, but the world changes. A hedge is an insurance policy against the scenario where analysis proves incomplete or unexpected events alter the equation. What hedges make sense for silver positions? First, consider the macro risk. If gold fails to reach $4,500 as projected, if central bank demand suddenly reverses, silver could underperform expectations. A hedge against this scenario would be maintaining a diversified precious metals portfolio, not concentrating entirely in silver. Include gold. Include potentially other hard assets. Second, consider the industrial demand risk. If solar panel technology advances faster than expected and thrifting reduces silver requirements by 50% instead of 30%, industrial demand could weaken more than anticipated. This risk is real. The hedge here is not to overweight silver as a percentage of overall holdings. Third, maintain sufficient liquidity outside precious metals. Do not commit capital to silver that might be needed for unexpected expenses or other opportunities. Serious investors maintain dry powder. They do not go all in on any single thesis. Employment data and economic headwinds. A critical variable that could accelerate silver's move toward $70 is employment data. The latest employment reports have shown weakness. When non-farm payroll numbers disappoint, when jobless claims rise unexpectedly, economic anxiety increases. Anxious investors rotate toward safety. They buy precious metals. They buy gold and silver. Weak employment data would likely trigger accelerated institutional buying, pushing silver toward $70 faster than the baseline timeline suggests. This is not hypothetical. This dynamic is already being observed in market behavior. If employment data continues deteriorating, expect silver to move higher with greater velocity. Decision makers should monitor employment reports closely. Weak data represents an acceleration catalyst. Geopolitical wildcards. The 5 structural forces we analyzed represent the baseline scenario, but geopolitical events operate on their own timeline. The Middle East, tensions that prop up gold's $4,500 projection, could intensify. Conflict could expand, energy prices could spike, trade wars could escalate. Any of these geopolitical shocks would accelerate precious metals demand beyond baseline projections. Silver could reach $70 in months instead of quarters. Conversely, unexpected geopolitical resolution or de-escalation could delay the timeline or reduce the ultimate price target. These are wildcards. They are unpredictable. Serious investors acknowledge this uncertainty without allowing it to paralyze decision-making. The forward-looking assessment. The most honest assessment for decision-makers is this. Silver at $70 represents a fundamentally supported price level with genuine structural support. The path from $60 to $70 is not guaranteed to be smooth, but the destination is rooted in economic reality. Employment weakness or geopolitical shock could accelerate the timeline. Technological innovation or demand destruction could delay it. But the equilibrium remains. Eventually, supply and demand will rebalance at a price near $70. Investors who position during this accumulation window, who build positions methodically, who hedge appropriately, and who maintain discipline will benefit from this structural recovery. This is not gambling. This is strategy informed by analysis. The question is whether decision makers will act on this analysis or wait for the crowd to catch up. History suggests the former always outperforms the latter.